let me tell you about the greatest financial product ever sold to the American worker. A product so trusted, so institutional, so deeply embedded in the retirement system that questioning it feels like showing up to Thanksgiving and asking if turkey is actually good. It's the 401k. And by the end of this video, I'm going to show you that the math behind it is built on assumptions nobody taught you. Assumptions that, if they're wrong, quietly turn your retirement plan into a decades-long donation to an industry you didn't choose to support. Now, before you start typing angry comments, I'm not saying don't use a 401k. I'm saying understand what you're actually buying. Because right now, most people don't. And the people who designed this system were very much aware of that. Here's the thing about the 401k. It wasn't invented for you. It was invented by accident. The year was 1978. Congress passed the Revenue Act, and buried inside it was Section 401k, a tax provision that wasn't even meant to be a retirement vehicle. It was written to help executives defer their bonuses. That's it. A loophole for people who already had too much money and needed somewhere to hide it from the IRS. Then in 1980, a benefits consultant named Ted Benna read the fine print, realized the provision could apply to everyday workers, and pitched it as a savings plan. And then corporations saw something even more interesting. If they switched workers from pension plans to 401ks, they could shift the entire burden of retirement risk onto the employee. No more guaranteed monthly payments. No more company liability. Just the worker, managing their own investments, absorbing their own losses, quietly hoping the market cooperated by age 65. In 1980, roughly 60% of private sector workers had a pension. Today, it's around 15%. The 401k didn't supplement the pension. It replaced it. And the people who won from that transition weren't the workers. Which brings us to the first number you need to know, the average 401k fee. Because fees aren't illegal, they aren't exactly hidden, and yet almost nobody talks about them in plain English. On average, 401k plans charge between 0.5% and 2% annually in total fees. That sounds like rounding error. But let that sink in. If you invest $100,000 in a fund charging 1.5% annually versus one charging 0.05% over 30 years at a 7% annual return, the difference is over $200,000. Not lost to a recession, not lost to a crash, just quietly drained every year into management fees, administrative costs, and expense ratios on funds your employer picked and you probably never researched. And here's where it gets worse. Most workers don't even know what funds they're in. The majority of 401k participants never change their default investment selections after enrollment. They land in whatever target date fund the plan defaulted them into, and then forget about it for 35 years, which is by design. Because when you're not paying attention, you're not comparing fees. And when you're not comparing fees, the fund managers win. Now, here's the pitch you've heard your whole life. Contribute enough to get the employer match. It's free money. And fine. Technically, the match is real. If your employer matches 3% and you put in 3%, you've doubled your return before the market does anything. That part is true. But here's what they don't say in the same breath. Most employer matches come with vesting schedules. That means you have to stay at the company for 3 to 6 years before that free money is actually yours. And in a world where the average worker changes jobs every 4 years, a big chunk of the so-called free money evaporates the moment someone takes a better offer. It's free money with terms and conditions written in the font size of a legal disclaimer. But here's the real mechanism nobody explains at the enrollment meeting. The entire 401k proposition is built on one assumption, that your tax rate in retirement will be lower than your tax rate today. That's the whole trade. Defer taxes now, pay them later, pocket the difference. But there are two enormous problems with that assumption. First, we don't know what tax rates will look like in 20 or 30 years. The United States carries over $36 trillion in federal debt. That number is going up, not down. And one of the few levers the government can pull to service that debt is tax rates. So you're betting that the same government running a $1 trillion annual deficit will charge you less in taxes when you retire than it does today. Which is like placing a bet at a casino, where the casino announces the rules after you've already sat down. Second, most people dramatically underestimate how much taxable income they'll have in retirement. Between Social Security, required minimum distributions, and potential investment income, a lot of retirees end up in a tax bracket that's not dramatically lower than their working years. The deferred tax arbitrage that made the 401 kick look brilliant may not land the way the brochure suggested. And here's where the history gets uncomfortable. Because the 401 kick as a mass retirement vehicle has never actually been tested at scale. The first generation of workers who spent their entire careers relying primarily on a 401 kick instead of a pension are only now reaching retirement age. And the early data isn't reassuring. The median 401k balance for Americans in their late 50s, people maybe 5 years from retirement, is around $185,000. Not $185,000 per year, $185,000 total, after decades of compound growth promises. And before you say, well, people just didn't save enough, that's partially true. But the system was also designed in a way that made it easy not to. Variable contributions, no guaranteed benefit, and a layer of investment complexity that would make a CFA candidate nervous. The whole product was sold as empowerment. It was actually exposure, which brings us to the uncomfortable modern parallel. Because the finance industry is doing the same thing again right now. Except the product this time isn't a 401k, it's self-directed brokerage apps. Zero commission trading, gamified dashboards, fractional shares, and the quiet suggestion that you, yes, you, checking your portfolio on your lunch break can outperform institutional investors with teams of PhD analysts. The 1978 Revenue Act shifted retirement risk from corporations to individuals. The brokerage revolution of the last decade shifted investing complexity from professionals to amateurs. Both were sold as freedom, which is a really great word to use when you're handing someone a responsibility they didn't ask for and a risk they don't fully understand. Because freedom and exposure look identical right up until the market corrects. Here's the uncomfortable truth. The 401 kick is not a scam. The employer match has real value. The tax deferral works under the right conditions. But the 401 kick as the primary retirement vehicle for an entire workforce was never a design decision. It was a corporate cost-cutting decision dressed up as a benefits upgrade. And the asset management industry that grew up around it, now managing over $7 trillion in 401k assets, has a completely different set of incentives than you do. They make money regardless of whether you retire comfortably. Their fee is baked in whether the fund goes up, sideways, or quietly drains 1.2% off your balance every year while you're busy living your life. You are not their client. You are their asset under management. And there is a difference, so I'll leave you with this. The 401k was handed to an entire generation as a replacement for a guaranteed pension wrapped in the language of empowerment and choice. And maybe it works perfectly for you. Maybe the tax math lands exactly as advertised, the fees stay manageable, and your balance compounds quietly for decades. But maybe it doesn't. And the difference between those two outcomes might come down to how closely you read the fine print your HR department definitely did not walk you through on day one. Drop your take in the comments. Are you still a 401k believer? Or do you think the whole system got quietly sold to the wrong people? Because that question is going to matter a lot more than most people realize, and a lot sooner than they think.